Hello everyone, welcome to this video. In this video I'd like to talk to you about the stock market because it's truly fascinating, and at the same time because stock markets are of major importance to national and global economies. So without further ado, let's dive into the topic and let's see where we're going to get at. So the first word in the phrase stock market that I'd like to talk to you about is the word market. So the stock market is not something physical, it's something digital. So it's not like the supermarket where you can go to, but it's more like something like this digital e-commerce website where you're normally buying your clothes or your shoes or whatever. And in this case, on this market, stocks are being bought and sold. And stocks, the easier word for you to comprehend today's story is the word share. So if you have a stock, you have a share of a company. And with this share, we mean share of ownership. If a company has 100 shares in total on this market being bought and sold, and if you hold one of these shares, it means that you are for 1% owner of this company. And it's truly interesting. I mean, through your app or through a website, you can actually become co-owner of the companies that you're normally seeing on TV and of whom you perhaps don't even know the employees of. And that's something very interesting and very important to realize. So this stock market, shares are being bought and sold, but before that, of course, the company needs to get on the stock market. And for a company to be able to get on the stock market, it needs to do an initial public offering. And this means that the company, through help of an intermediary, is going to, for the first time, get access to the stock market and is going to supply stocks. These stocks, as said, provide ownership, and in some cases they can also provide you with dividend. And dividend is that this company is not only giving you ownership but also part of its profits, which makes it even more interesting. You're not only able to gain through value gains off the stock, but also by the profits that this company is making. And even more so oftentimes to invest, a reason for investing in this company. So dividends actually increase the demand for a stock. So in general, after this IPO and after stocks are supplied on the market, people can from each other buy and sell these stocks, and that's what the stock market all is about: buying and selling ownership of various companies. And it's very interesting if you think about it. I sell ownership in Apple, and you buy it from me, and I go from someone else and buy ownership in Microsoft, for example. So demand and supply, in this case for stocks, are not any different from demand and supply in general that we know from economics. So if there's more demand for a share than there is supply of it, so if more people want to buy a share than that people want to sell it, of course the price of a share will go up. And so how do we determine whether a share is worth the money? This boils down to valuation. We look at a company's revenues, at its profits, at its cash flows over the course of time, and then this course of time we discount back to today, because as time passes by we have inflation and of course the cost of capital, which is interest. And so we can discount those money flows in the future to today and see actually how much value a company is able to offer compared to other companies, right? Because there's something like opportunity cost. We can only, with let's say 1 unit of money, only buy 1 share at a time. And so we have to make the right investment. And because of that, we have to make our valuation correctly. On top of this, we can look at a company's liquidation value. So if a company is going to be liquidated, so it's going to be sold completely, what is left in our hands, which is a safe way of looking at the tangible value of a company, but much less about a company's future potential and about its goodwill, for example. Then we have also the balance sheet value, which is looking at a company's assets and at its liabilities and comparing these with each other and seeing what's left as a residual value. So what's especially interesting of a stock market is that it looks at a company's past, today, and tomorrow. Because investors, when they're doing these valuations, are looking at a company's past performances to determine what they can do today, and are looking at the company's today's performances to see what a company is able to do in the future. And so an investor actually takes like this complete look, and based on all of this information, prices in the share what he or she thinks that this share is worth, right? So this we call pricing in, and this automatically also means that the share price does not reflect what we don't know. Right. So coronavirus was something that we didn't know. We didn't see it coming. So the moment that it came in March, we saw the market crash because investors saw something that would affect the companies that they were shareholders of, and so that they had partial ownership in. And they did not want to carry the losses that would come with the coronavirus, and then so decided to massively sell stocks. And we saw tenths of percents decrease in companies' value. We saw actually the same thing also yesterday. We saw the stock market again crash, though much less than previously, because people are afraid that something that was not priced in shares, which is a potential second coronavirus outbreak, that this would again hurt their profitability, company profitability, and with that the potential of their shares to increase in value over the course of time, and their dividends, because a lot of companies, because of, for example, the coronavirus outbreak, have decided to suspend their dividend payments, again making a demand for shares contract, decrease. So markets can crash. And at the same time, sometimes we see much more sudden movements. So sometimes the market increases on average for a couple of days. This we call a bull market. And sometimes a market is decreasing for a couple of days, weeks in a row. And this we call a bear market. So a bull market or a bear market is dependent on, of course, market sentiment. Do we expect the coming days to really be good? And do we get confirmation for this day after day? This makes an investor, of course, keep on investing more in shares day after day. And then we will see, of course, also stock market expand in value. Now, there are also a couple of things, a couple of terms that I would like to share with you before we come to the end of the video. Going long in a stock or going short in a stock are terms that you'll often be hearing. Long means that you're going to invest in value gains of a company. And so oftentimes this simply happens by buying a stock. Why is this interesting? Well, because the flip side of the coin is very interesting. You can actually, as a financial product, also buy going short in a stock. And this means that you're actually buying the fact that the company is going to make losses and is going to perform less than people are thinking. So you are actually arguing that the market has not been efficient and that the past, today, and tomorrow have not reflected some information that you as an investor know. And so you're actually going to buy the possibility that the company is going to do less good. And you see in moments of crisis that especially these people are really, really profiting from their right decisions that companies would decrease in value. So if you would, for example, go short in February, then when the market collapsed in March, of course, you would have had a very profitable period, even though people who were going long and so bought the possibility of an increase in value, these people, of course, lost a lot of their money. The final thing that I would like to talk about are options. So we don't have to per se buy stocks today. We can also today buy the option of buying the stock later on. We accept on the price, agree on the price. That price I have to pay today for this option, and then I have the chance to buy this stock at a later moment in time for a price that we're agreeing on today. These are options, futures. You might hear this in the news. This is simply today buying the possibility of buying the stock later on in the future. I hope that now it has become more clear why in March and yesterday we saw a decrease in the market value. It is simply because people saw something coming that they did not price into the market, the share, and they didn't want to be owners of the companies in such a period. And that is why a lot of people sold the shares simply. Thank you for your interest. This is the Stock Market 101 video. In the future, I'll be talking more about the stock market, so please stay tuned. If you like the video, please hit the like button and don't forget to subscribe on my channel. I wish everyone all the best in the world. Stay safe. Take care.